Coming up, the Australian share market hits a 2-month high. China's central bank injects even more stimulus, and a record number of Australians attracted to shares. It's coming up. It is your daily 10-minute business and finance news wrap for this Tuesday, the 20th of June 2023. Later, why the Australian share market hit a 2-month high despite the ongoing threat of rising interest rates. But first to a snapshot of the ASX. And according to the Australian Securities Exchange, it says a record 10.2 million Australian adults have direct share market exposure. The pandemic attributed or attracted 1.2 million Australians to shares, and 22% of those that started investing since 2020 were younger, aged between 18 and 24. For more, Rhayna Bosch spoke with Andrew Campion, the General Manager of Investment Products and Strategy at ASX.
Yeah, probably the most pleasing result is just the number of new investors. Since the last time we did the study in 2020, we've had 1.2 million new investors entering the market. And even probably more pleasing than that number is how many of those are female investors. Right on 50%, or 600,000 of those new investors are actually female investors. So that's a great trend to see.
Now, the pandemic saw a lot of people redirecting their extra savings towards investments. What are you seeing now that that trend has kind of come to an end and we're in the midst of a tougher economic environment?
Well, the key is that investors should really have a long-term view or a long-term horizon when it comes to investing. It's almost impossible to time the market when the right point is to enter and exit. There's even an old saying, it's time in the market rather than timing the market. So there will be volatility. Markets do go up and down. They are very sensitive to economic news and other developments. So the main thing is investors, particularly new investors, should have a time horizon of at least 5 or 10 years for when they invest in things like shares or ETFs.
Do you think these new investors in particular are aware of the risks associated with entering this market?
I think there's still quite an education gap. That's why organisations like ASX, ASIC and others put a lot of time and effort into educational resources. But we are seeing particularly younger investors are taking quite risky bets in areas like cryptocurrencies. What they really need to learn more than anything else is just the power or the importance of having a diversified portfolio.
Why then would you say that younger people are turning to the ASX as opposed to other investment forms?
Well, as we all know, Australians love property investing. We hear a lot about it, we talk a lot about it, but it's becoming harder and harder for people to get that first leg on the property ladder. Even a deposit for an apartment in Sydney or Melbourne can be hundreds of thousands of dollars, so that can take quite a lot of time to accumulate that sort of savings. So people realise that the entry point into investing in the share market is so much lower. $500 is really all you need to start, and you can buy a diversified ETF for that amount of money and really reduce a lot of your risk through going about investing in that fashion.
Andrew, financial advice has been a hot topic of late. What is the ASX's view on this?
Yeah, what the study shows is that only about 25 or 26% actually have actually accessing financial advice. But what we're also seeing is that the data shows that 34% actually want to have an advice relationship, but just think that it's too expensive. And some of that is due to the regulations and the changes we've seen over the last few years, particularly in reaction to the Hayne Royal Commission. But there is, I think, moves to try and reduce the burden on advisors, because there's a real gap. People are only willing to pay on average about $1,200 a year to have a financial advisor. But we know anecdotally from outside the study that the cost of providing that advice is 3 times that, between $3,500 and $4,000. So there is a big gap between what people are willing to pay for advice and how much it costs to provide that advice.
And Andrew, what other key trends are you seeing in terms of where people want to be putting their money?
Is a big trend. We now have 2 million Australians that are investing in ETFs, and that's great because they're a very simple product. It gives you a diversified portfolio in one trade. They're transparent, and it also gives you the opportunity to invest in overseas markets, the US, Europe. Markets have traditionally been much harder for Australian retail investors to access.
And finally, Andrew, what kind of top-level advice would you offer people who might be looking to invest in the ASX longer term?
Well, I think the main thing is to have a plan, have an idea of what your risk appetite is, what your goal is, and what the time horizons are for that goal. Once you have those things formulated in your mind, the main thing is to try and build a diversified portfolio. And again, products like ETFs are a great way of doing that in a very simple and cost-effective fashion.
Rhayna Bosch there, speaking with Andrew Campion of the ASX.
Now, Market Day on the SBS On The Money podcast.
The Australian share market rallied today, up 0.9% on the S&P ASX 200. That is a new 2-month high, and that was thanks to energy, real estate and banking stocks. For more, I spoke with Mike Jenneke, a portfolio manager at Credit Suisse. Mike, we've got an inflation problem. Interest rates are still rising. NAB today, the latest, to say that it expects interest rates to peak at 4.6%, yet the share market is at a 7-week high. Why is that?
Well, the share market rally has been driven by a combination of economic resilience so far this year and an ongoing confidence from investors that inflation has peaked and is in the process of decline. So that's the broad trend. Although interest rates are continuing to rise, it remains likely central banks are approaching peak policy rates and are moving cautiously as well. And that was really illustrated by the Reserve Bank minutes today, where they described this month's rise as versus a no-rise alternative as a finely balanced decision. So from our perspective, we've had incremental upward revisions to interest rate expectations, but they largely reflect resilience in the economy. And there's therefore implies there is a stronger ability to absorb rate rises while maintaining that growth path and moderating inflation.
Still, we are seeing consumer discretionary companies seeing the impact of rising interest rates. No, I mean, Best and Less today issued a profit warning as sales drop. Is it a concern, even when we see these companies which operate on a value end of the market doing so poorly in terms of sales expectations?
Well, the growing pressure we're seeing in discretionary retail, such as occurred with Best and Less, is not really surprising to us. I mean, higher rates do transmit to interest rate sensitive sectors first, and it really has been a question of time as to when the effects would be felt on the spending side. Although there are budget conscious retailers that continue to be supported by their customers, cost of living pressures for essential items and higher mortgage repayments simply means that discretionary spending in many affected households needs to decline. The other thing that we'd point out is that traditional retail is on a pretty high base of spending when compared to pre-COVID levels. And we still remain in a phase where spending on goods is normalising, while services spending in areas such as travel is still recovering. So from our point of view, the downgrades we're seeing across the retail spending spectrum are likely to broaden.
China, let's talk about it for a while. Cutting more key interest rates again today. Is this a good or a bad thing? I mean, doesn't it suggest its economic reopening hasn't been as strong as first thought as it came out of that protracted COVID lockdown? And what is the outlook for China now?
Well, the outlook from our perspective is that the economic recovery will continue, but it is correct to say that the rate of improvement in recent months has slowed down. So unlike other economies, the Chinese household sector did not receive the same level of government support through the pandemic. They do have an elevated level of youth unemployment. And these factors are also weighing on areas of property, for example, which was already struggling before last year's lockdowns. So where China is at is that inflation is pretty low. The economic recovery can therefore be stimulated by policy support and reinforced by that direction. So that's really what we're seeing. The authorities are acting to provide some interest rate cut support, and there'll be other stimulus measures to ensure that the recovery continues at the pace that's been targeted by the authorities.
And finally, where do you see the opportunities for investors at the moment?
Our global view is that amongst the major asset classes, our preference is for fixed income. Yields are now at much more attractive levels than they were, and default risks remain pretty low. When we look at the equity side, we're cautious globally, particularly on the US share market, where the AI theme has led to a very narrow group of stocks performing strongly. And that does lead to some risks in regards to the durability of the rally. But on the other hand, on Australian shares, our global view is actually positive, and that's really reflecting the attractive dividend yields and reasonable valuation. Sectorally, we like resources, banks and general insurance. There you've got attractive dividend yields, reasonable valuation and less direct impact from higher rates and the economic slowdown.
Mike Jenneke there from Credit Suisse.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.